Okay, so we are on, and as well, I will just share.
All right, thank you so much. Again, thank you so much, ladies and gentlemen, for joining us on this webinar. It's Wealth by Design, Building Your Personal Investment Strategy. It's a webinar for April, which is the Financial Literacy Month. So this webinar has been hosted by Finance for Families and Positive Circles. So karibuni sana, feel free. If you have any questions, kindly write it on the chat box so that we are able to pick it up even as we continue our discussions. So just to introduce the speakers and the host, I'm going to be your host. My name is Deborah Uma. I'm the founder of Positive Circles. Positive Circles is a community for women where we empower women to learn, connect, and impact. And financial literacy is very big for us. So this is a very, very important webinar for us because it gives us more skills to just learn more about money and how to grow our money, how to make more money. We are also joined by Samuel Gishohi. If you came for Let's Talk Money last year, he was our keynote speaker. He gave a very robust session on stocks and how to invest in stocks. He's the head of retail sales brokerage unit at NCBA Investment Bank. He's got over 17 years of experience in capital markets as a trainer, analyst, and business development leader. He's quite conversant in investing across different classes. So I'm sure we'll find his session very helpful. Mm-hmm. And yes, we have Linda Makatiani, who was, yes, Salimia, wave to people, Linda. Linda Makatiani, she is a wealth strategist. She's also a finance coach, and she's really on a mission to help individuals and their family just build lasting generational wealth, stability, and growth. So really happy to have you, and I'm really looking forward to this discussion. So I'm going to hand it over to you, to Linda, so that you can start us off, and let's see what best we can learn this evening. Asante sana.
Okay, thank you, Deborah. And yes, very warm welcome to everyone for this session where we are looking at how do we design our wealth. You know, it's not just about talking about money. We need to put those ideas that we have into like proper structures so that you can be able to achieve them. So I will take you through the foundation bit, which is where we're getting to understand what is this when you're talking about, yes, we want to design our wealth. We have to understand in which environment we are looking to design this wealth in. So it's very good to get to know who are the key players in this. And so at the top of it, we have the regulators, and we are looking at, so if we are going to start investing and looking at those investment options, who are the key regulators? We need to understand what they do. They license, they supervise the financial institutions that will be engaging as we are going about our wealth building journey, which includes saving and investing, which I'll talk about a bit about. Gishoyi will also come and talk a lot more on that as well. So the two key regulators that you are bound to come into contact with is the Central Bank of Kenya. This is the financial markets regulator. So the banks are regulated by the Central Bank of Kenya. And then there's a Capital Markets Authority. So if you're dealing with investment banks, if you're dealing with brokerages, dealing with fund managers, so those ones are regulated by the Capital Markets Authority. And later on, we'll see why it's very key to know these regulators. And then after that, when you're thinking about the market infrastructure, when you want to come in, you have to open accounts. There are platforms that you have to use for you to be able to trade. So this, now you get to interact with the Nairobi Securities Exchange, which now provides the platform, which now when you're coming into either trade, buy or sell either stocks or bonds, you would be using the platform that is hosted by the NSE. When you're opening the account that you need to be able to trade to be able to now to invest in stocks, to be able to do secondary bond trading for the corporate bonds, you would be now required to open an account, and the CDSC would be now that institution that at some point you would interact with to have your account open. When you're thinking about the dividends that you are looking to earn, because I know we are coming into this space, we are looking for what are those options that we can be able to take part in and make some money, you know, earn those dividends, get those coupons and everything. So when you're thinking about dividends, then the registrar is an institution that, you know, you'd need to know for the company that you have invested in, who are the registrars. If you ever have issues, you have not received your dividends, then that's the institution where you'd be engaging with. And then now we come and we look at the market intermediaries. When I'm looking to buy stocks, I don't go directly to the Capital Markets Authority and tell them, you are the regulator, so I want to open an account with you and buy stocks. There are those intermediaries that we go through. So this it would be a stockbroker, so you'd open an account with a stockbroker, would be interacting with the investment banks, would be the fund managers when you're looking to invest, to save open an MMF and all that. So so now there are those ones, and then there's us now, the investors. So when you get to understand these parties that will influence, or at some point they will come up in conversations you're having as you're building wealth, and you also understand, so what role do they play in that, in your wealth building journey, in your wealth design journey? This is very key. You have your regulators, you have the ones who provide that market infrastructure, and then you have the intermediaries, who's now your first point of contact, and then there's you as well. Yeah, so once we understand, yes, the key players in that space, then we start looking, okay, fine, what are the options that are there for me? I want to build wealth. What are these options that I can be able to take into consideration? And we want to look, because very key when it comes to wealth building, tell people, when you're eating food, when you go out there, they won't just put for you. You don't go to a nice place and then they just put for you potatoes. Even if they put potatoes in like a love heart, it doesn't look as appetizing as if you have potatoes on one side. So take potatoes on one side, you have your protein, either meat or salmon, nicely done with some garnishing on the top. You have a salad or something. So if the plate is well presented, put together, different colors, different types of foods, it's more appetizing. So employ that same when it comes to your investment portfolio. So look at these options, and then in as much as maybe you might feel safe with just one, it's always good to know what do the others entail, and can I be able to participate in investing in the others. So we're going to look a bit on fixed income, which is basically where you are giving money either to the government or to a corporate institution, and because they have taken this money that you would have otherwise used it for something else, they say for this period of time, every so often, for us it's every 6 months, they will pay you some return. So you know that every 6 months I'm going to get this return up until that duration matures. So we look at that. We look at equities, which is stocks where you are buying a portion of the company. And when that company performs well, then, they come back because you gave them money, they pulled that money, they were able to go out there, do all these projects. So they give back by saying, okay, fine, we have made X profit, so a percentage of it is going to go back to our shareholders. Then you get to make money from that. We will look at putting money in money market funds and the special funds, the newest and I think most popular kids in town, the special funds. Everyone is asking about those ones. So we'll look at those in detail as well. We are looking at REITs. This is where you are thinking about having an exposure in real estate, but at times when you think about the capital intensity of actually being able to buy that property or buy that piece of land, you feel like, hey, I'm not there yet. So the first option that you normally go with is to say, let me put the money that I have. I always say the little that you have, because everyone says, I only have a little bit of money. So you take that little that you have and you put it. It is pooled by the REIT manager, and then that money that is pooled, they'll be able to either put up like commercial properties, like an office block or an apartment block, and then it converts and now it becomes a generating property. So if it's rental, then they'll be getting rental income. If it's office space as well, they will lease out that office space or sell the building and make money. And once they make money, you will get your returns in proportion to how much you had put in. So this becomes an easy start to having the real estate exposure in your portfolio as well. So yeah, that it's a growing interest as it is now. And we have, I think the main one we have the Fahari iREIT, which is out there for professional investors. But I think the one which is most popular for us as retail investors is VUCA, through the VUCA platform, which is the Acorn investment, where you're able to pool money, buy units, and the money that is pooled is able now to go in and construct the hostels that we have, the young people in universities and all. Then the rental income that is collected gets paid now to you as a unit holder in the form of dividends twice a year. So yes, that is also a consideration. And then we have SACCOs, where we are thinking, I want to go to pool money. At some point, I might want to buy either a piece of land, or sometime I might want to be able to maybe acquire a car or buy a house. And if you go through the mainstream banks, I know Gisho is here from a subsidiary of a mainstream bank, but the reality is, if you go through a bank, the rates that you actually get charged are a bit higher. So the better option is to see, can I be able to save some money and then be able to X that so that I can get a loan and buy this property. So we have SACCOs out here that, dependent on the contributions that you have made, the share capital that you have, on a yearly basis, even if you're not borrowing from the SACCO, on a yearly basis, you're able to get dividends from this. And again, we are here, we are looking at how can we design this wealth portfolio of ours to be able to be giving us some level of return. If it is in income, if it's appreciation, then we sell and you get some capital gain. So SACCOs is one of those ways. I think for me, the key consideration, especially when it comes to SACCOs, a question I normally get, is it really worth it to join a SACCO? And I'm like, don't do it as a lone ranger. I think for me, that is one key insight I've seen. People who thrived as being part of a SACCO, especially if at some point you are looking to take advantage of the credit facilities, is don't join it as a lone ranger. Either be there with your family or people that you know very well or you're close to, so that if at some point you need to be able to take a loan from the SACCO, you have people you trust that can be able to guarantee you and all that. It really pains when people join, because the SACCO has a very good reputation, but then you don't know anyone. You want to take advantage of the opportunities that are there, but because maybe your deposits are not enough, you would need to guarantee you, and you don't. So key insight for SACCOs, yes, they do work, but if you're in a group, chamas and all that stuff, consider if you're going. Of course, you'll join individually, but then you'll be able to support each other, because now you're accountable for each other in that aspect. So for REITs and SACCOs, as well as I said, REITs, it's a growing interest. It's very good to look at it as a starting point when it's coming to getting exposure in SACCO. Again, we have said, yes, good. I know people who are building and planning for their retirement using SACCO. So they're saying, I'm going to get my SACCO contributions and share capital to this amount, so that every year when I get paid my dividends and the rebates, there are a good enough amount that I can be able to spread it throughout the year and have something that I can, use on a monthly basis when I no longer have income. So it becomes like a supplement to your pension income. So that's also something else you can consider using SACCO for, if you have. So I'll take us through fixed income. We'll talk a bit on equities. Sure, you can chime in, and then now we'll look at the funds as well. So when you're thinking about bonds, this is a prospectus, the latest prospectus that we have. And this is issued by the government. So I've said bonds, it's either issued by the government or issued by corporate. So we look at the government one. And they're issued on a monthly basis. So we look at it, we get to see. So this time they have issued 3 of them. One has 6 years to go, 13 years to go, and 20 years to go. So very key things that when you look at it, because I know most guys, they see this prospectus and they go like, so what am I to be looking at when, you know, when I see something like this? There's so much. So very key again is, yeah, so you have to look at the tenor, the duration of this bond. Yes, you're going to be paid periodic coupon interest, which is every 6 months. But when you're designing your investment portfolio, you have to, one of the considerations is to look at the duration. So this is, I'm looking at it from, is it 5 years? Is it 10 years? So if you're looking at a 5-year duration, then really like a 20-year bond would not fit into that 5-year plan. So you look at the duration, and then of course you look at the return and the taxes as well. So the longer the bond, the lower the taxes. So all these bonds initially were more than 10 years. So any bond that is less than 10 years, you'd pay a 15% withholding tax. But any bond that is more than 10 years, you pay less, so you pay 10%. Then we have the infrastructure bonds, which now there's no tax on it, which are the ones which are most popular. And I know most of us are waiting for it. We all are, you know, I'm hoping someone at CBK and hearing this, as the retail investors, we are really keen on having an bond coming up. But yeah, so you have the duration, you're looking at that, you're also looking at the coupon, because this is a return and this is fixed. So when we are talking about fixed income, the reason why it's called fixed income securities is whatever return that is agreed upon on the onset, that will be your return up until maturity. Yeah, so it's a good thing because then it keeps you, it gets you to be able to now plan yourself properly, because you know, I'm going to be paid every 6 months, either January and July, on a certain date. This money is going to be coming into my account, and it comes into your account on a Monday. There's nothing as good as receiving money on a Monday, and you know, money from the government, as well on a Monday. But yeah, so there's that, and then again, it's just to see how much money am I willing to put in, because in as much as yes, for these bonds, you can come into the secondary market and sell to someone else. Your initial goal should be to be able to hold it up until maturity. So if it's a 6-year bond, make sure you're putting money here that you can be able to wait up until it matures in those 6 years. So for me, what I always tell my clients, very key, as you're getting these returns, you have to also make sure that this interest that you're getting from the bond, you are able to employ it somewhere where it also starts earning interest for you, as opposed to spending it and then at the end you get. So if I put 1 million shillings down, I will get my 1 million shillings at the end of 6.6 years. But every 6 months, I am going to be getting a return. That return that I'm getting, where am I putting it? You know, now that is designing your wealth portfolio, because if you spend it and then at the end of 6 you get 1 million, and of course because of inflation that 1 million has lost value, then really it beats the purpose of investing, because investing is supposed to grow, to help you grow this money, to keep it safe from it. So when you're thinking about bonds, that again, another consideration or insight I would share when it comes to bonds trading is to also look at periods for investing in bonds. I know we say we cannot time the market and everything, but once you are in the market, it's very easy to understand. So which season is good for me to be able to invest in a bond? If I'm putting my money, and I've said it's fixed. So it's fixed. If it's 20 years, it's going to be fixed for 20 years. So part of the consideration I need to make is, if I'm going to be earning 13.92% for the next 20 years, is that a good enough return for me to fix my money there for those 20 years? Yeah. The best strategy to use is always to try and make sure that when the bond rates are high, when, you know, we are at those 16 at 17%, lock in as much as you can at those high rates, because it is fixed at that high rate. And if it is low, then when the rates are lower, you look for shorter term investments to make, so that by the time it matures, you're able to put your money into like another investment which can earn you a bigger return. So those are part of the insights now you use when you are designing your wealth portfolio. So that's on bonds. When you're looking at it, this is a prospectus from the Central Bank of Kenya website. When you go in on their dashboard, you don't have to maneuver. Just on the dashboard, you can see the bond results. You can be able to see the bond prospectus in what is on offer. They are on offer every month. So, and I'm hoping now at least we have more insights in understanding what are we looking for when we are making that decision. Do I put my money in this bond, or do I wait for maybe when the rates are going up? Right now, for those of us who have been very keen in the market, you've realized, yes, there's been not that much activity in the bond market because the rates have been down. We are coming from regime where we know bonds were at 17–18%, and we are likely to go back at least to levels close to that in the near future. So it's also good to figure out, can I be able to park my money somewhere so that when we get to those good rates, we'll be able to, I'll be ready to invest. I will not start looking for money at that particular point in time. So that's very key on when it comes to fixed income investing. It's good. It has those two sides. It's fixed income, it's guaranteed, but then it's also fixed in such a way that whatever you have agreed now is what takes it all the way up until maturity. The other option you have is looking at investing in stocks. Now, last year, for the ones who were with us during the Let's Talk Money, where we were saying girls just want to have stocks. We are very, very keen on making sure we are not just sharing information, but we are giving you opportunities, spaces for you to be able now to start that wealth building journey. And I was telling Deborah, this for me was very key. I wanted us to share and look, because that was last year. So 52 weeks, yeah, give or take. So if we just pick one, I don't know if, let me try and see if I can be able to just, yeah. If you can just pick one, let's look at maybe KCB here. So in 1 year, KCB has moved from 35 shillings to 80.50. This 1 year is from last year. So if you are there for the Let's Talk Money, you got to open your account, your stocks brokerage account. Gishoyi and his team were there. You already had an existing account, and you said, oh yeah, now I've learned. Gishoyi really shared a lot of insights when it came to investing in stocks, and you're able to do that. Then that means you bought it at this price. And it's between that time and now, it has gone to levels of 80.50. If you think about Standard Chartered, from 260 to 370, and that is how the market has behaved. What does this tell us? Yes, it's very good to have these sessions where we are getting here, we are getting insights and all that. But let's put these insights into action, because this is the opportunity that we are missing. This is the opportunity for those of us now who maybe took up. It's also looking at to see, okay, fine, so I bought KCB at 35. It got to levels of 80. So what did I do? Because if you don't take any action when you're in the market, then it's really just what we call paper profit. You can smile very hard and say, oh my God, I'm looking at my portfolio. Imagine I bought at 40 and now it's at 80 and everything. But if you don't take action, then really that is not profit that is realized. And I think Gishoyi had shared, in as much as, yes, we want to do accumulation, it's also good now to employ that strategy where you're looking at, if I've made this profit, I can be able to realize that profit and move that profit into another investment that can also now make some more profit for us. And these are the things you get to understand, especially when it comes to investing in stocks. One, time is very important because over the long term, the companies that you have invested in are growing. They are expanding and all that. So even the dividends that you end up earning slightly more dividends. But there are also other opportunities in between that you can be able to take up. as opposed to just saying, okay, I'll just keep buying KCB so until I get to 20,000. So it's being able to also put time into the market. When you put time, you're also able now to understand what are these opportunities. And again, you know, work with the people who are in the market. Myself, 𝐞𝐲 is here and his team. They will be able now to direct you and say, okay, our recommendation is this. You have made 40 shillings out of this. There's an opportunity in this other company or this other investment. Then you'll be able to take that one up, you know. So your investment portfolio works in your favor. It helps you to grow what you call your risk capacity and all that. And consistency, again, is very, very important. Don't do those ones of putting money and then going and sitting and waiting, and you're just getting dividends and eating the dividends, and you know, not you. Make sure you reinvest those dividends. Make sure you look at the market and see, as you've said, what other opportunities are there in terms of the profits, the capital gains that are there, and then work with people again who can be able to give you insights. Because 𝐞𝐲 will tell you they have a whole team and a team of researchers who their work, and they will not pick like the whole market. There is someone who's just specifically looking at the banking stocks, the financial sector. So they're able to go deep and just now make projections and say, this is a strategy of Absa Bank. This is where we see it growing. So our recommendation is, you know, buy at this point. When it gets to this one, you know, sell it, buy something else. When the price comes down again, now you can be able to accumulate more at, you know. So all those things, there's a whole team that's it. So take advantage of such, and then because that also helps you to keep consistent in the market. I don't know if 𝐞𝐲 you have something to add when it comes to stocks investing. I was trying to summarize what we talked about last year, and to just get people to see, if you are not part of this, you have missed a lot in terms of capital gains and the opportunities that are presented themselves between the last Let's Talk Money and today's session.
Thank you, Linda. Yeah, you know where to get me. Eh? I love my stocks. Yes, I think it's key to see that volatility, that movement in stocks, is a very big money maker for people who are able to follow those patterns. But all in all, in the long run, markets have gone up consistently, in as much as we have several times that they go down consistently for as long as we know the market. There's always a higher high going to come every few years. So I think it's about patience. It's about understanding what you're investing in. If you don't understand it well enough to explain it simply, if you can't explain it simply, you don't understand it well enough. And I think, Linda, you've done a very good job of explaining it simply, which means you do understand these things. But yeah, it's important to do this in as much as you're not necessarily doing it with the maybe capital you want to protect. It's always good to have a little risk in your portfolio, because what it does is it speeds things up. You can make money in the fixed income, and you can make money in the funds, money market funds, but usually the returns will be more to protect your capital than it is to make you a lot of money, because you're not really beating inflation. But now when you come to stocks, if you had bought something like Kenya Power last year at the beginning for around 2 shillings, you'd be trading it above 15 shillings, 16 shillings, I think. Linda, I don't know if you can see it from where you sit. But yeah, I mean, that's almost 20 shillings actually, and that's a lot of return. That means if you had put in 2 million, you would have 20 million. Think about it. It can be huge. It doesn't mean it can't go down, but we're also there to help you with strategies on what to do when it goes down. Back to you, Linda.
Yeah, that's very true. So again, it's very key when you put time into the market. Yeah, that time can really reward you, especially in the stock market. Yeah, so we have seen bonds, we have seen stocks, we've talked of SACCOs, we've talked of REITs, and now you want to look at the funds, because I feel like this is where most people, it's mostly our starting point. So when you're starting out, you're always told, have that emergency fund in place, yes, put some money aside into that sinking fund. Again, for me, I always encourage my clients to have what I would call investing fund. So put some money aside, park it there, so that whenever an opportunity comes, you're not looking for where will I get money. You're just saying, okay, fine, let's go in. There is money sitting in this fund. So it's very good for us to also get to understand the funds that are here. That will now enable us to either save or also just take up some investments that maybe we feel like we don't have enough in terms of money to go in as on an individual capacity. So we have money market funds. This is as at December. So the Capital Markets Authority normally shares a report that gives just a rundown of the figures. You know, numbers are very important when we get to see. And for me, I always like to ask people. So we are looking at this. This is 423B. So are you counted as part of this? You know, do you have that fund? Because if you do, then your money is here. So we have the normal money market funds, which I think everyone talks about. We have talked about them for quite a while. Then we also have fixed income fund, which now are quite popular because when we see the results, the kind of returns we're getting from the fixed income fund, then they're quite competitive and attractive. So we are getting people now also putting a lot of money into the fixed income fund. We have, you know, the special funds, which now we look at in a bit as well, which have really grown in the past 2-3 years. They become very popular with us. We have the equity funds, which have struggled because most of this. So the fixed income fund, you just pick that name, fixed income. So the fund, any money that is pulled here is largely invested into fixed income securities. So it would be investing in bonds. If it's the equity fund, then you know, any money that is pulled here is largely put in equities. Balanced, of course, now it will be a bit of the two. So it's just getting to see that you see still MMFs quite popular, but you also have the fixed income fund and the special funds. And with me, I like to talk numbers. You know, I like us to see the numbers so that if you are not there being counted, you can also see what it is you're missing. So some of the key considerations for me, I feel like when you're thinking about, yes, I want to have that MMF, maybe I don't have, but I am here because I want those insights. So what do I need to look out for when I'm choosing that money market fund? So of course, you're putting money there. You don't want it, you know, it's not like putting money under your mattress. You want it to gain some returns. So you'll be looking at what returns am I getting. As well, this is money that you want to be able to access easily. So you have to think about how easy is it for me to be able to withdraw my money for that emergency that I have. You have to look at the fund manager reputation. Again, as part of that, the report that CMA share, they'll always show you like so which funds are registered, are regulated, and then how much in terms of assets are they managing. So you look at their track record, how much they're managing for people. You know, this shows how many other people out here believe in their capability as a fund manager. And then the governance structures, who's managing this fund, what's the experience, you know, and all that stuff. This is very key because we've had issues. We've seen people going to court and then they reach there and realize, oh my God, it was not a regulated fund. So if you're putting your money, I think key is just to make sure that it is a regulated fund, meaning the Capital Markets Authority has licensed it. They have their people looking to see where they are putting this money that you have put there. And they also have an independent trustee and custodian. So these are the people. So to just avoid that situation where they have a lot more power in deciding what to do with your money as the fund managers, there are those checks, you know, that are in place to make sure that your money is being invested in the right instruments, the right risk level, and all that. So I think we can see this, the kind of returns. So we have the fund managers and the kind of annual returns that they are able to do. So these, again, are not fixed, but it's just good to observe them over time. You will get to see that sometimes it's the same fund managers that are there. So that's for the normal money market funds. And then you have the fixed income funds. You see these ones are, the returns are slightly higher. Again, as we've said, when the bond prices are inversely related to the interest. So when the rates are down, then the bond prices are up. And to think of it simply, if I have a bond that is returning, it's giving me 17%. And right now, what is there in the market is going to give someone 14%. that person would be, very happy to buy my bond so that I can get that 17, 18% as opposed to that other bond. So that will just get you to see that when the rates are low, then already existing bonds at higher rates are more attractive to all of us. And now the fund managers are able to play around, go into the market, trade these bonds, and through those trades, they're able to get good returns. And now that translates into the interest they're able to give for the fixed income fund. And that's why we are seeing the fixed income funds being popular, people putting their money here. So if you have a lot of money sitting in an MMF, again, an insight, just compare and see, yes, you can have the MMF. The features are normally the same. There's no lock-in period, so make sure you also start looking to see how can you get these better rates when it comes to your funds by putting some money into the fixed income fund as well. The special funds, two key things you have to be able to understand as you think of putting money here. I know most of us just look at the results, the returns. You're like, hey, Mansa X is doing 20.7. And these other ones, they're doing what? 13%. Maybe I want this 20%. But you're not looking to see this 20%. What does it come with? First, there's the minimum investment, which is higher than normal money market funds. The normal one, you can do 1,000. This one, you have to do 250. There are those management fees that will eat into this return that you're getting. For some of them, they have the normal fees, the management fees, and then they have the performance fees. Meaning, if they get you, the better the returns they get you, the more they also take from you as well. So that also eats into your return. There's a lock-in period, 6 months. So put money here, yes, so that you can be able to get into these returns, but also understanding the management fees, the performance fees, the lock-in period, the risk level, and all that. But yeah, so this is also an option that you can be able to do because it gives you exposure to like the global equities markets, the currency markets, the derivatives, which sometimes if you're thinking about going in it individually might be a bit, capital intensive for you. So this is a way that you can be able to get exposure into the global markets without having to go in directly. And I think we got quite some questions on some of, when you're talking about funds, we got a bit on the NCBA funds. So let me get 𝐞𝐲 to just take us through this and then talk us through just everything from considerations to some of the common challenges we are going to experience, likely to experience when you're putting our strategy together and everything. So 𝐞𝐲.
Yeah, thank you, Linda, and thank you for a very good introduction. So I'm going to start with what's in front of you. This is really just to show you the sort of returns. This is just following up on what Linda has just talked about. And we were just looking at some of the funds that we run, the NCBA Investment Bank, which is where I work. These are the managed funds. And of course, for you that want to do equities or shares, we have that side of things, but you can also invest in shares through what we call the equity funds. So if you look at the money market fund, and you remember earlier I told you, most of the funds that give you fixed income returns will tend to be geared towards them protecting your capital and giving you a lower return because they're low risk and longer term. Now, this is good for protection. And this is where you put money that you may need. For example, your nest egg. You don't want to have money in risky assets, which can be below the price you bought when you need the money, if that is your nest egg, which means is the money you would use if you're in an emergency, your emergency fund. And so if we look at the NCBA money market fund and the NCBA fixed income fund, both of them, we have the dollar denominated, and we have the shilling denominated ones. And you will see, you may be wondering what's the difference between a money market fund and a fixed income fund. Our money market funds, by regulation, can only invest in very short-term fixed income securities, which are those bonds and the treasury bills that Linda was talking about. The tenure of what they can invest in is very short. And so they will tend to give a return that is mimicking the CBR rate, which is the rate that the government has put as the target rate, or the 1 year T-bill, 1 year treasury bill, whatever the 1 year treasury bill is earning. Now, so you'll find that if you look at last year, the money market fund gave a return of about 7.5, but then the NCBA fixed income fund gave a little more. And the reason for this is by regulation, this is allowed to invest in more longer term papers. Now, remember, in what we call the time value of money, if you're putting money in for a longer time, you'll tend to earn more money. So think about it as if you're going to lend me money for 5 years, or you're going to lend the government, because that's what a bond is. You are expected to make more money if you lend for 5 years than you're lending the government money for sorry, there's a bit of noise in the background. Sorry about that. So as I was saying, the fixed income fund they're able to invest in longer term papers, and if they're investing in longer term papers, those papers will tend to give you a little of a higher return. Of course, there are times when the market can change and the shorter ones get a higher return. And a year or two ago, we had only the fixed income fund, and that's where we have introduced the money market fund, because sometimes if there is a change in how the interest rate and the government is issuing bonds, then that would cause one of them to be higher than the other, depending on whether shorter term interest rates are higher. But normally it should go upwards. Now we have the dollar funds, which you can see are giving you between 5.16% and 4.24% for the NCBA money market USD fund. But you can see that again, the fixed income fund, because of the longer term nature of the funds, then there's a tendency for it to give you a little higher. Now, if you go to the global fixed income special fund, this one invests globally. So there's money in China, there's money being invested in different places like the US and the UK and wherever. And this one is only for fixed income, meaning it's a lower risk, but you can see it's giving you 8.7%. This one to join is about $1,000. The others, the fixed income fund and the money market fund is only 1,000 shillings to join. The others for dollar fixed income and money market fund, those are $100 to join. And the one with the global fixed income fund, that is about $1,000. Is a bit of the higher end. You can also see we have an equity fund. Equity fund to join is also 1,000 shillings, but the equity fund invests in shares. And you can see the difference between now shares, which did very well last year. You can see those funds that were doing shares, the equity fund made how much? The actual it made was 44.1% against the benchmark of 40.4%. So we even beat the benchmark that we have, although we beat it on all the other metrics. At this particular return, if you had invested 1 million shillings in January last year, you'd have had 1.44 million. So that was very good. You can also see the global equity special fund made around 24% against an expected 22.4%. Now that again shows you that when you're dealing in shares and the market does well, you can accelerate. But because there's a risk, you can buy and it goes down. You now need to diversify your money. It's where there's some risk you're taking, maybe on the interest you earned from the money market fund, you now put it in shares, so that then you can now start leveraging yourself. So I'm not going to go too deep into this, but at the end of the day, when you come into all these funds and shares and everything, we talk to you and have a conversation with you, get to know what kind of risks you can take and other things that we're going to now discuss as we go through. So I'm not going to spend a lot of time on this because some of these things we did mention them last year. But I just always like to start with the reminding people that it's not how much you earn, it's not the little you earn, it's what you do with the little you earn. When I say what you do with the little you earn, and I'll give you a very story very briefly. There's a group called Kitemoto SACCO. I don't know how many of you have heard of it. You can show of hands if you have heard of it. Kitemoto SACCO was started when two border riders were stopped in Kitengela. It's Kitengela Motorcycle SACCO, and they were arrested. And when they went to court, because the police refuse to bribe. When they went to court, they were charged 10,000 each. All the Ndudi guys gave some money, 100 shillings. And when they were released, it turned out that after they paid the 20,000 shillings, they still had some change. And that was the day they decided that they would keep giving 100 shillings every day. No boda would ever pay a policeman a bribe. They would always go to court. And eventually, the cops didn't stop them anymore. And then they started buying each other motorcycles because they were on other people's motorcycles. At some point, they all owned motorcycles. And this is on 100 shillings per day. And they eventually went, and today they're over a billion shilling SACCO. They built houses, all these guys, they built houses for every one of those guys who own a part of the motorcycle SACCO, a 3-bedroom house. You can find that on YouTube, just find 𝐾𝐻 SACCO. And then they built a housing estate. So there's a chance the guy who drops you from your housing estate to the bus stop on a motorbike in Kitengela is actually your landlord. Now think about it. It wasn't how much they had, it's what they were doing with the little they have, they are earning. Now there's another SACCO, there's another group of guys in my village who work in the local market. And because they usually finish from bringing vegetables from the forest by around 9 in the morning, they contribute, each of them, I think, 50 bob. And this 50 bob ni ya kufungua lock. Now you can imagine where they are now in comparison to 𝐾𝐻 SACCO. So again, it's what you're doing with it. And that's the same thing that happens with your salary. It's not what you earn. It's what you do with that little you're earning. What's the plan? What system do you have? Is there a structure? The moment you have money and you don't have a structure, there's a problem. And that's why by the time we retire, we have people in different places. There's people who retire financially free. Only 1%, very few of us retire financially free. And then there's those, and financially free means money is not your problem. And it doesn't mean you have a lot of money. It's according to the lifestyle you live. So you don't have to be a billionaire to be financially free, and that you can live your life without borrowing, without worrying about your expenses, and very comfortably. If you want to travel, just do what you want. They call it self-actualization. Financial independence just means if they lose your job tomorrow, and we saw this during COVID. Certain jobs stopped, hotels and all that stuff, isn't it? And what happened is we started seeing high-end cars parked by the roadside, the boot is open and someone is selling sukuma wiki from his backyard garden. And why? Because then you need to continue with a certain lifestyle, but you haven't created enough wealth or enough passive income to support you. Other people start depending on family. It's a really sad situation, but it's not that they weren't earning good money. It's because when they were earning, they didn't plan it. So when they stop earning, then they're the guys who come back and remember they once paid your school fees and expect you to support them. Some people end up going to look for work. The guy was a policeman at Sasa ni soldier. And of course, he'll always tell you stories about when he was running as a policeman, but now he's retired. He can't run after anyone. And you've seen sometimes there's some very old guy carrying you in an Uber who probably worked for many years and retired, but now has to continue working to survive. Then there's the 30% who die of stress. Of course, this is always, I usually remind men, they need to be part of the family because they're the ones who die most of stress. 95% of these are men. So I'm here, I'm among women, so that's a story I won't tell today. But as men continue trying to live like their great-grandfathers doing nothing, the children see their mom, and the guy ends up being isolated because when he had money, he spent it doing strategic things like watching who will win the next Premier League, who's going to win the Chinese Iran war, those kind of things. Anyway, let me not go there. Now I might be kicked out of the men's conference. Anyway, so let's go to the importance of budgeting. Investment is about disposable income. Now, I've seen people go and take money they need and they go and invest, especially when it is in risky assets. So investment is not that money you need. Of course, there are ways of investing money you need, because nowadays we have some funds like the fixed income fund and the money market fund, which also give you liquidity. Interest accrues on a daily basis. Every month it starts to compound, but at the same time you can exit anytime, either partially or fully, with no penalties and no consequences. Now that means you can actually look at your savings account and say, look, my savings account is giving me what? Almost nothing. Actually, probably less than what we call probably less than inflation. So if then the money market fund or fixed income fund is giving me 7%, I'm beating inflation. So if I have money, if I get my salary today and I know I don't need 50,000 until maybe next month or until later in the month, why don't I put it in there and it will be earning at least even a shilling every day? Money is money, even a small money is still money, isn't it? And I always tell people 7% of a million is, and 7% of a shilling is still 7%. And that's why in finance we talk about things in percentages. It's just that the guy with a bigger piece will make more because of the amount he has, but generally you still made the same amount in terms of returns. So when you're budgeting, you need to look at what are your liquidity needs. What are those things you cannot survive without? But we always say pay yourselves first, and you can see there half savings, an emergency fund, your debt repayments and investments, so that you look at what you use in a month and take out a chunk of it and say this one is for those things that I need to build. These are the building blocks. Now, you'd be surprised, but and I know most of us are not doing this. I can honestly tell you, this one is, I know you're watching, or you're looking at this and saying, this is impossible. Because a lot of us, you're saying 30,000 needs is for needs, rent, bills and groceries, transport and health. And you're thinking, I'm at 100,000 and you're telling me I can only spend 3,000, 100,000. So I can only spend 30,000 on all this stuff. And I'm thinking, but I cannot, even what do you call those things in Kilimani, the servant quarter thing, what is it called? Yeah, that one. Where
Studios.
Yeah, there's those studios, yeah. You know,
not excuse their studios now.
I'm TBT. I saw things we played with in a museum the other day. So I'm getting old, I guess. So anyway, but yes, you shouldn't be spending more than around 30% on your electricity bills, your groceries and all that. Try and get close to that. You're not perfect. You don't have to go to there and do like those debts that end up killing people. No, just go and, start trying to move towards that direction. Eventually, you'll probably get there. Unless there's wants, things that you just want to do, dining out, holidays, fashion, entertainment. You can decide to save these 10%. Of course, I know for us who are of religious incline, you have your 10% tithing and all that, whatever you're doing, but you need to have a plan. I'm not making the plan for you. I can help you. That's what we do for a living, but you need to have a plan. And don't have the plan in your head. Write it down and start with shorter term goals, then medium term. You don't have to do everything at once. You can say, in this year, I'm going to reduce my debt to this much. I'm going to increase this. I'm going to do something. The first step is the first in a journey of 1,000 miles. So unless you change, you'll always have what you have got. We do things that are self-sabotaging, and unfortunately, we do them in our subconscious. Remember, we are the second or third generation of Africans to have money, and we live in heaven. So in the African context, anything that happens, we have to celebrate. We didn't need to save because there was abundant food around here. If I needed food, I just walk down the road, I catch a small deer, I come, we eat. I was telling people, if you look for a cockroach in Europe, not a cockroach, a squirrel in Europe, and you look for a squirrel in Africa, in Kenya, they behave differently. If they mate, they are actually same genetically. But the European one will find a nut and dig a hole and put the nut in the hole. The African one, it even shows, or it throws away some nuts. There are too many nuts. They're all over the place. And they're always there. Because the European squirrel knows there will be winter. It's preparing. Something can happen. Now imagine those guys who lived there are the ones who came here with money. So us guys, sometimes we do things with money and you're wondering what's wrong with us. But it's just because of where we come from. We like to celebrate life. Anyway, let's move on. So then what happens is, first, we don't design and implement a clear and workable financial plan. What am I saying? I usually walk in, and I would like you guys to actually do this. Okay, you win the lottery, 20 million. Now, pap, it's in your account. What are you going to do with it? You have 5 seconds to think of what you're going to do with it. Even if it's buy something or do something, what are you going to do with it? I know some of you will. Okay. But anyway, give me in 1 or 2, 3 words, like how you're going to, what you've already planned. Now, a lot of people will end up saying, oh, I'll go to real estate. I hear a lot of that with my people from Mrima. I'll buy plots, you know, or I'll do, you know, we do what someone else did, and we think they made money from doing that. And that means you're following other people. It's the hard effect. You're just doing it, and that's where we see all these DESIs, and you've seen all those different pyramid schemes that thrive in Kenya because we don't have a plan. I saw someone open a salon, and I decided that now that they're driving, even me, I'll open a salon because I'll drive because I opened a salon, and I know nothing about hair. You know what I'm saying? So think about it. If you got your 20 million and you went and said to this stockbroker, I want to buy a bond, 20 million, that gives me, let's even work with 10% a year. Now, if that bond gives you 10%, if that bond gives you 10%, well, what's 10% of 20 million? That's 2 million shillings. Now, let's assume it's an infrastructure bond. That's tax-free, 2 million shillings. Now, I don't know how much you earn right now, but 2 million shillings, if you divide it by 12, is a pretty good salary, isn't it? Now, you're going to get this money twice in 2 tranches in a year. So I'll take that money and go to my money market fund. And I'll tell them, look, put this money, I'll be sending you this 1 million every 6 months. Put it in my money market fund. And then I'll let that grow maybe for a year, and I'll tell them, whatever I'm making from that money that I'm making from the money market fund, I want you to be putting it in my bank account every month. Now, it might be a little money, but over time, that money will start to be money you can walk into the bank and say, look, I've seen a plot somewhere, and I want to build a flat. And I have this bond that is covering all this stuff, and I have these earnings, and this is the money that comes into my bank account every month. And you can see the bank gives you credit based on what? Collateral and consistency. So they give you a loan, you go buy a plot, build a flat. Now you have shared the risk with the bank. You're paying for the loan, but the loan is being paid for by your 20 million that you put in there at the beginning. And now you have tenants who are paying, the building is paying for itself. You come back and start from ground zero, and you start wondering why we call these people with a lot of money and flats and what. We start calling them Illuminati, but they just had a plan. Okay. Anyway, let's go back to this story. So the other one is, of course, failing to acquire knowledge on investment vehicles. And this is what we are trying to do in this forum. Trying to tell you, look, you need to understand these things. What's for the short term? What's for the medium term? What's for the risk and all that stuff. Because sometimes what we do is we go and we start doing things we don't understand. And when we do things we don't understand, we make poor investment decisions. Somebody decides, okay, me, what I'm going to do is I'm going to retire. I'm going to buy some cows. I'll be going, I feed those cows and I milk those cows. Then I take that milk to the dairy, and you have just left your employment and retired to be employed by your cows. That's because now your life is waking up to work for cows so that they can give you milk to go and sell, which is something you could have used in your working years. You could have put money away, come and put these cows. Have you seen those ones with them and a blanket and a guy to take care of them? Build it as a business. Come as a shareholder and just check how are things going every end of month or when you have a board meeting. So again, we need to be careful about those things. Then we start. The biggest problem that we have as guys is the inability to overcome fear and negative beliefs about money. How does that work? Have you ever seen what happens when, say, we have, God forbid, a bereavement, or it's a wedding thing, and we come together and we're like, okay, let's changa, and Kenyans and Africans, Harambe, we love to changa. Have you ever noticed it's always easy to get a chair lady? Oh, that's a chair lady. Okay, good. Yeah, she's very good at organizing. Then usually we go to the treasurer. Africans, we fear money. We believe money is for other people. We don't want it. We have. It's like money is a taboo. That's because we were brought up. Remember when you went and told your parents you had school trips and everything, they would tell you, "Hey, boss, you think money grows on trees?" And it's true, money does not grow on trees, it grows in a tree. Now, we were programmed to be workers and employees. And so what we do is we were taught that money is something, it's even taboo to talk about money. Now go to the street, find a European, these guys walking around with backpacks. Ask him, what do you do for a living? They'll tell you, I have 2 jobs, I work 2 jobs, one in the morning, one in the afternoon. They'll tell you everything. And they'll even tell you how much they get paid per hour and all that. And they even tell you how they survive on that. They have no problem talking about money. Find an Asian. Okay, I've lived in India, so I can do an accent. But then you find an Indian, theirs is more family. You know, daddy has 1 million, mommy has 20,000, we have to put it together, it works. They'll tell you, they don't have a problem. Ask an African how much they earn. Ask them, you're asking me, now it has become a fight. Because we were taught that money is something we should fear. You should not even talk about money. Even flossing, look at, now we have this celeb life, but you can see we still have those people who feel that it's even a sin, you know, to just enjoy life with the money you made. Anyway, so again, you start missing opportunities because whenever we come and talk to you about investments, you think we want to con you. You're giving me only 5%, and there's a guy there at Desi giving me 20% or 30%. So you go to give the guy there because he has 30%, because your friend in a pub told you they earned 30%. 2 months later, you're back crying. There is nothing. It's all gone. You see? So if it sounds too good, think twice. All right, let's move on. So again, it then means that you need to start with a plan. You need to wake up and say, my goal is to replace my salary in the next 5 years. What do I need to do to replace my salary? I earn maybe 100,000. This 100,000 is what I pay rent, meaning it's supporting my family, and I'm good. The 100,000, if I can replace this 100,000, it means that whatever I'm doing, I can stop working. Remember, you need to always ask yourself, when can I stop working for money? So this is why you ask that question. How am I planning towards that goal? It doesn't have to happen instantly. And that's where we come in, where you ask us a question. If in 10 years, I want to be earning 200,000 per month, how much would I need to invest in what and how so that I can get there? That kind of mathematics we'll do for you. Linda has been in the industry for years. We are able to advise you and show you this is what the journey looks like. And then we tweak it depending on your risk, and then we end up now with a goal. Now, write down what does it look for me. For me, guys, what Wamrima, financial independence or freedom, is Probox, Mobebiri, Zarapo, some mahindi I take to the soko and I eat the machoma and the muridi with my buddies. Where from my brothers in the lakeside, my friend, is a whole different story. Yeah, the car has to be a statement. You know what I'm saying? Yeah. So yes, we just behave differently depending on our attitude towards money. So anyway, then we need to start looking at how do you balance what growth we are making and what income we're making. Remember, if you invest in the low dividend, or say, remember the money market, the safer, it's called the risk return trade-off. The less risk, the lower the return. So if you're lending to the government, you're getting a lower return because there's less risk. But that means you're not really growing. What you're doing is you're just making an income, isn't it? You're just making that interest that is coming in. But are you growing? Now, the growth comes with risk. The more risk you take, the more you can grow. And that's why we always say, invest for the long term. Now, a lot of people say, invest for the long term means I buy Safaricom shares at 10 bob, they go to 20 bob, but I don't sell because I am investing for the long term. And then they go back down to 20 bob, I do nothing because I still get a dividend. That's income now. You are just getting dividend. Whatever they are paying dividend is just their profits. Now, but if you're keen on what's going on around you, is market forces like now Trump's tweets will always affect the market. You've noticed there's a guy who keeps buying just before he tweets and then selling just after he tweets and makes billions in a few hours because somebody is doing something funny. But yeah, it's happening. But normally, if you're able to call, if you hear there's a war starting somewhere or COVID is coming and you think, no, this will hard stop the markets. So let me sell my shares, put my money in the fixed income account and wait. because I know usually if interest rates are going up, shares will tend to start coming down. So I sell my shares, buy the bonds, and start buying bonds as they go up. By the time the shares are at the bottom, I still have my money here in my fixed income account. It's been earning money, it's never slept. Now I can take it all back and buy the shares so that now as they go up, I make a killing. So that's why we keep giving you information on what we think may happen. But at the end of the day, you make sometimes you make a lot of the time you make a right call, as long as you're using the right information. Now, have you noticed that every time I'm talking about something, I'm diversifying? I started with safety, then I took some risk, then I decided I'll take even more. I'll borrow money. I diversified into a debt. Debt is also an investment because it gives you the ability to leverage. Then I took a debt and diversified into a risky business, which is building flats which may never get a tenant, right? Or on land where it floods and I didn't know, and it can happen. Those are real risks you might face. Okay, it's not normal, but remember, even real estate is still quite safe. So, but I'll probably take the profits I'm getting from that flat now and come and put them in shares. Now I'm risking way beyond. I'm risking very little of what I'm getting now from the end investment, but at the bottom of it, there's a 20-year bond that is giving me a very 20 million bond that is giving me that 2 million like clockwork. Now you can see I've just created a diversified portfolio that is sitting in different assets. Maybe if I feel Kenya is a risk, I buy something global, so that now whenever something happens, this one is going down, the shares are going down, the bonds are giving me money anyway. And they're giving me money even to buy more shares. And now you have started the wealth cycle. That's where now you see guys sit back, tell you I'm going to live in the Seychelles from now on. You find them at the horse races. I know me and Linda have horse racing history, but that's behind the tent. Anyway, so then how much are you putting where? Remember, you can't put all your money in a bond. Remember, when I'm putting that money in a bond, I already have a salary, so I have liquidity. But if I don't have a salary and I put my 20 million in a bond and they will only pay me money in 6 months, what am I eating in these 6 months? If an emergency happens in these 6 months, what's going to happen? So I'm going to end up trying to sell that bond. And sometimes you can sell a bond when it is not in the money, or not be able to sell it in bits. Maybe you have to sell the whole thing. So that liquidity aspect, you have to be careful. And you see, I created liquidity by taking the 2 million I get, putting it somewhere where I get some money every month, and that's liquidity. I decide to send it to me as if it's a salary, so that every month I'm getting some money. I don't need to ever sell the bond. And that's what I'm saying. We need to look at how are you allocating these assets so that there's no assets sitting in the wrong place and at the right or wrong time. Because if you're in bonds, we are getting into a more risky Iran USA war, whatever. I would rather my money sitting in what? In a bond. But then when things turn, then I want to go to shares because money is circulating. Then be consistent and patient. Remember, those guys are putting 100, 100, 100, 100, and over time, it accumulates. You don't need to start with 1 million. Just start with the 100. It will start compounding next month. It will end by the end of the year. It will be 101. You put another 100 next month, and they will start compounding. And that is a huge compounding. Is actually, according to Warren Buffett, he's the 8th or 9th one of the world. And then now we start tracking and reviewing and starting to see maybe we should remove a little from the bonds and put a little more in the shares, depending on what is happening. We start looking, did we do the right thing, or what is happening now in the market that would mean I start maybe moving my money around and changing the way my investments are placed. Next slide. So as we wind up, my action point is you need to ask yourself right now, will your earnings build your future or finance your problems? Today, we think everything is urgent. It needs to be done now. No, I have to do it now. And so that dress becomes more important. And it's a temporal choice. It's about now versus tomorrow. Maybe that's why, even when we look at those of us who are religious, we say, yeah, I invest my faith in my faith now because sometime in the future I'll get the big payback, right? And yeah, sometimes how you build it now, how you start putting those building blocks, you will get to what we call critical mass, maybe in another 4 or 5 years. And you realize I'm only working because I enjoy this job. And you can be able to say, okay, I need to look for another job, and I'm leaving, but even if I don't get another job, I'm already doing well enough to live, to survive, and to live a good life. So that's where it all sits. And the decisions you have to make. One, toxic debt. We all have that friend who calls us and says, send me 10,000 and then I'll send it in a few hours. You just know that's a mobile loan. That mobile loan, you pay more than a credit card. It's around what, almost 100 more, almost 100% what you're borrowing in a year. And so start paying off those big debts, whatever you can, because if you have a debt that is a Sherlock that is telling you that you give them 30% a month and you give them 10,000, that's 3,000 shillings. If you pay that 10,000 shillings today and get rid of that debt, you have just earned yourself 3,000 per month. Think about it that way. Now you have another 3,000 to start paying down another debt. Then if you pay down another big debt, maybe earning you 20%, now you have an extra 2,000. So now you have 5,000 shillings. You're building, then you can get out of debt eventually and start to restructure your finances, then start to get disposable income. Another thing I always talk to people about is lifestyle change and behavioral change. There's certain things you do in life. It's just those things we do in life that are really messing our finances. We walk into the supermarket without a list of what we want even to buy. You know, we start buying things, what do you call it, spontaneously, you know? And sometimes just look at what you're buying. Is it at eye level? Someone's paid for it to be there, so you're also paying a margin for that. It doesn't mean it's better quality than that one at the bottom of the shelf that you can buy for what? For a few shillings less, but it is less money. I know we have many mothers here. I always do the shopping in my house. That I live long and I'm old and the children with me coming home with stuff. But anyway, if you buy the Pampers, and I learned this because I'm the one who used to go and buy the Pampers. If you buy the small one, there's 3 packs. There's the one with 8 in the pack. There's one with 32 and there's one with 64. Now, we always make the assumption that the one with the most is usually the cheapest. We usually told is what? The economies of scale. But I usually do the math. I say, there are 8 Pampers here. How much is 1 Pamper? So I do that division, and those days my daughter is now 10. So the last time I bought it many years ago, but 1 Pamper was 28 shillings inside that 8 shilling pack. Then you go to the one of 32 and you think that it is cheaper, but you do the calculation and 1 Pamper is about 31 or 31 shillings, 2 shillings more for each. Then you go to the big one, the price goes to 28. And I realized somebody has realized that the rich and the poor are driven to work, but the poor middle class drive themselves to work. They're the ones who buy on that assumption, and they're the ones with the most money. And that's why most supermarkets are on Gong Road. they're in an area where we are the middle class, not Karen or where. That's because we are the ones who are more likely to say, I'll buy the 32 one because I just have enough money for the month. So why am I buying? If the baby will use 30 Pampers during the day, they use something else, but at night they use the Pamper, then that's the deal. So again, are we looking at what we are buying? Are we buying sachets or tins? You know, what are we doing? Are we calculating? Are we doing a budget even as we go to the supermarket? If my kids pick something I hadn't in the budget, it's not going out, but I wait for them to get it up to the till so that I take it out of the basket as they watch. They're like, oh, Dad, oh, I'm like, yeah. Well, you are taking it. It wasn't in my budget. You know? Let's talk about it. You wash my car, I'll give you the money, you'll come and buy it. Anyway, it's a bit of tough love. So again, invest consistently. Just be disciplined, take small steps, and eventually you're going to see a difference. So next slide. I think I've taken more time than I should have. So I'm done. Thank you so much for listening to me, and I hope you can now think about it. I'm just going to say this here now because Linda and Deborah were laughing at me. One of the lifestyle changes I made, and I have someone here I'm challenging because they had also made that lifestyle change with me when I made mine, is rather than drive to work, I cycle to work. I've been cycling to work for 6 years now. Today happened to be the most rainy day in my 6 years. So I was calling on my way home and saying I'm still on the bike. But anyway, that's besides the point. But I don't use petrol to go to work, meaning I'm saving around 1,000 shillings a day. I'm not telling you have to cycle, you can walk. I eat the same food I would have eaten, so I'm not spending more on food. I usually carry my food as well. Then at the end of the week, I look at how much money I would have saved. That's 6,000 I would have used. Plus, at the end of the month, I would have paid for a gym. Let's assume a gym is what, 5,000-6,000. So now I have 12,000 that I have saved through my habits, and I can decide to go and sit in a hotel with my family and enjoy ourselves, or go and invest it and then have another nice week, enjoy myself. I'm not worried about fuel when I'm sitting there. I'm not worried about fitness, and it just gives you a better life. Now, some people walk to work, some people will do whatever they do, but carry food to the office. Just these little small things can add up to that shilling you invest at the end of the month. Thank you very much, and sorry for taking too much time. I got the gift of the gab.
All right. Definitely do. Thank you so much, Gishui. But yeah, I think it's just that for me, again, as a parting shot, it's when it comes to finance, it's called personal finance for a reason. Gishui will look at his lifestyle and say, for me, these are the changes I want to make because, one, it's getting me healthier, it's getting me to invest more time in my family, and all that stuff. So for each of us, I think that is a challenge. I don't know who he was referring to about we started this together, but it's just for us to look as we are designing our portfolio. That is also part of our portfolio, because the portfolio is supposed to be able to finance the lifestyle that we want to live. And our lifestyle does not mean then that because, I'm getting all these dividends and interest and coupons, then that means now I can just, living la vida loca. I'm everywhere. I'm in Bali, I'm in whatever, and all that stuff. It's true. As well, you want to be there long enough to enjoy the fruits of this investment portfolio that you have been able to design. So yeah, challenge to all of us. Personal finance is very personal. Everything that we have talked through today, we are looking, I want you to look at it from a personal lens. For me, where does it start? What changes do I need to make? And again, this is very important. Where you are right now, the portfolio that you have, however big or small you think it is, how is it? Is it building your future, or is it just there to finance your problems? And then now ask yourself, so what is that action that I'm going to take based on what now Gishui and myself and Deborah have been able to put together to help you design your portfolio in such a way that it stops just financing your problems, but builds a future not just for you, but for the other generations to come. So I had shared it on the charts as well, just A or B for you. I think let's challenge ourselves. What is it doing for you now? And what do you want it to do for you in the future? But yeah, thank you so much. So Deborah, you can take it up from here. Debbie, umebebwa na mvua. I hope you're still.
Yeah, I'm so sorry. I was on mute. Thank you so much, Linda, for that very rousing presentation. My takeaway is that we have different asset classes and we can really make it work. So I'm really excited just to get and continue on that journey with you. Samuel, you've put the name Wayne Jugun. I think it's your son's name. So some people are calling you Wayne even on the on the chat board. But Samuel, thank you so much.
Yeah, that's my nephew. That's my nephew. So in the hurry to get into the meeting, I took his laptop. Yeah, Samuel Gishohi.
Samuel Gishohi, of course. So thank you so much for that presentation. Always very engaging. Can't wait to continue on that wealth cycle. I really like the way you've explained diversification in a way that is very understandable, and in a way that really we are able to really protect the assets even as we grow in terms of income. So this has been a very interesting discussion. I've linked the feedback form on the chat, so kindly take a minute before you sign out to fill in the form. It's really important, and it really does lay a foundation for future webinars and future events. This has been the Let's Talk Money series, and this one was specifically for the Financial Literacy Month, where we decided to host a free webinar. The next webinar on Let's Talk Money is going to be on 12th of May in honor of Mother's Day. We are going to be having Diana Morethi giving an all girls. So Samuel, unfortunately, you cannot join us for this one. And it's really going to be about how women can protect our wealth. We've been seeing.
Can I wear a dress and like mingle?
You can try and see if you can.
Yeah, I'll buy
a Yes, but we're going to be having a very interesting discussion on how we can protect our wealth through various instruments. So please save the date. We're going to be sharing more information. It's going to be a virtual call on the 12th of May, which is also a Tuesday. We'll also be having another event for Father's Day. It's going to be a mixed event, and we will invite Peter, the CEO, Peter Washira, the CEO of ICA Lion Trust, who's going to be talking more elaborately on how to create trust funds so that now we're able to do our succession and generational wealth planning even better. So if you want to get in touch with Linda Makatiani, she's a financial coach. She can help you structure your investments, put your money into good use. Her contacts are on the screen, so kindly get in touch with her. If you'd like to get in touch with Samuel Gishohi, he is excellent in terms of stocks. If you want to open a CDS through NCBA, if you want to get more insights through NCBA, kindly get in touch with Samuel Gishohi, and he will be able to guide you through the right instruments. My name is Deborah Ouma. I'm the founder of Positive Circles. We are still recruiting members. We have about 2 more days before we close our membership. So kindly get in touch with me. My email is you can also have inbox us on Instagram or LinkedIn, and we'll be very happy to talk to you. So the 2 sessions, yes, Sharon, they can be shared on calendar invites so that we don't miss. And we really appreciate the kind words. We really, really, really do. So we will do that for sure, Sharon. So it's been lovely having you. I hope that you learned a lot. I hope that you're going to put your money into good use. You've seen what has happened. Sharon, we have been watching the stock exchange with Sharon. So there have been so many gains, but it's never too late to get onto that wagon. So please put your money to good use, make the right decisions, and always stay tuned for more events around money. We really know women in Kenya enjoy money. So thank you again, once again, and good night from us. Bye.
Bye. Good night.
Good night.
Thank you so much,
Anthony, good night.
Good night.
Thank you. Good night.
Good night.
Thank you.
Good night. Thank you. Kindly share the feedback.